Okay, I'm going to try to walk you through what we need to do to complete the financial analysis assignment. I have opened here the pro forma spreadsheet and I've gone to the top down versus bottom up revenue page. We're going to begin with the top down revenue forecast. If you remember from the lecture, the top down revenue forecast is going to be just like on this slide. Remember, we did top down market size. So we start with total addressable market. We calculate the target market within that, the target segment within the target market, and then we estimate a market share of the target segment to get our year one revenue forecast. We're going to do the exact same thing in the spreadsheet here. This is total addressable market. We're going to, first we need to define that. So for example, for Meticulously, which we went through the example in class, this might be we could start with a really big total addressable market like the medical device market in the US because we know that they're targeting US market, or we might do something a little more well defined than that, like the 3D printed implant market in the US. But we can use our judgment to decide where do we start with total addressable market. Then we'll enter a growth rate for the total addressable market over the forecast period. Uh, this we need to derive through a combination of secondary market research and our own estimation. Target market as a percent of total addressable market. This gets us into the second ring in the bullseye diagram. And then target segment as a percentage of target market, which is the number above. That'll give us our target segment size. So now we're in the second to innermost ring in the bullseye diagram. If we take a look at that again, you can see we've arrived at here. We're in the target segment. And then we're going to grow the segment at our estimated growth rate, which is most likely going to be much faster than the total addressable market overall growth rate because presumably we're targeting a fast growing segment within the overall market. Then we need to estimate the market share. So again, this we can do based on we might start, for example, with the company numbers if we think that that's reasonable. We might want to check the company numbers against our own again secondary market research and see if we agree, and that'll give us our 5-year revenue forecast. So if we remember meticulously, I think they were looking at something like 107 million in the 5th year. So this number is a little bit lower than that. So we would look at do we agree, disagree? Let's just to make it match, we'll increase these numbers now. So now you can see we have pretty similar year 5 revenue forecast from top down. And that's step one. So we've done top-down revenue forecast. Of course, when you do it, you would be going through in a lot more detail to get all of these assumptions to make sense with whatever your analysis is. Then next step is bottom-up revenue forecast. So you click on bottom-up revenue forecast at the bottom. Now there's a lot of numbers here because this is done monthly. It may not be necessary for you to do the bottom-up revenue forecast monthly. So you might want to do that separately on an annual basis. And the concept in bottom-up revenue forecast is you would try to estimate what is the company's ability to supply the demand that we calculated in the top-down revenue forecast. So if we went back here, again, looking at Meticulously, for example, we would say in the year one, they sell $425,000 worth of product. Since we are starting with an assumption that each unit costs it sells for $10,000, then this means they would sell 42 and a half units in the first year. So then to think about, okay, does that make sense? How many hospitals might they enter in the first year? How many cases will there be in each hospital? And then how much, therefore, multiplying that number by 10,000, how many cases would that imply? And then you go ahead and do the same thing for the remaining years. The key here is to make sure that you believe that the top down and bottom up makes sense so that there's nothing in the top down forecast that can't be explained in a reasonable bottom-up forecast and vice versa. You remember the estimate and iterate concept that we went through in class around this process. So the end result of this process is that we have this number, year 5 revenue forecast. Ideally, we have it both calculated in a top-down, bottom-up approach. Worst case, if you can't do the bottom-up approach because you don't know enough about the business model, you can't get the information from the company or whatever, don't worry too much about that. As long as it would be great if you have both top-down, bottom-up revenue forecast. If that's just not feasible in the timeframes that we have, just do the top-down, because I know you can do top-down revenue forecast without any additional information from the company. In the end, if you do both, then you should still have a single demand for a single revenue forecast, because you're going to iterate until they're the same. So remember or copy this number. I'll do a copy now. This is actually the only number that we need moving forward to the next part of the financial analysis. To do the next part of financial analysis, we're going to go to the tab that's called Valuation VC Method. So we go to Valuation VC Method, and I'm going to now paste the value that I took from the revenue forecast, just the value, not the formula. You remember that this was our estimate of the total revenue in the exit year. So you got the same number, 105 million. Okay, now we're going to use only this part of the spreadsheet. Standard VC method, not linked to DCF. We're going to ignore the part at the top that's called linked to DCF. We're going to, next, we're going to input this number here. Now, you can see that this cell is labeled year 5 earnings. Don't worry about that. We're not going to use year 5 earnings. We're going to use year 5 revenue. So if it makes you feel more comfortable, you can change that label to revenue. But the formulas work the same way, whether this is revenue or income. So we're going to copy that number. We're going to put it here. Okay, so now we have our year 5 revenue number. And the next thing we need is our exit multiple. Exit multiple means, we discussed this in the last lesson, exit multiple is at what multiple of revenue do we believe that the company is likely to sell when it's acquired by a larger company in year 5. So here we have the year 5 revenue forecast. Now we need the year 5 exit multiple. Now this number is derived from market data. Market data meaning what is the typical M&A transaction in this sector priced at, and specifically at what range of revenue multiples are transactions in this sector priced at. Now, how are we going to get that information? A couple of ways to do that. Again, secondary market research. For example, we could go look at Crunchbase. So Crunchbase is an online database that has information about startup acquisitions and also a lot of information about VC investments and acquisitions, funding rounds, etc. So if you don't have a Crunchbase account and you don't want to pay for one, if you have one, great, you can use it. But you can sign up for a test account and get, I think, most of the functionality on some sort of trial basis. Here, I'm already on the acquisition tab. I picked past year acquisitions, and say we look at MedTech. Oh, okay, healthcare. Let's see if we can find medical device. So here's healthcare medical device. So we can click on healthcare medical device, and now we see for the last 1 year, we see a list of all of the M&A transactions that are included in the Crunchbase database, which are all going to be venture-funded startups. And it shows you what was the summary of transaction, the industry, who was the company acquired, and what company acquired them, when was it announced. And you can see we have almost 200 results here. Now, not all of these transactions are going to have the detail that we need to get the revenue multiples, but some of them are, because we're going to see here is the price. So this is how much the company was acquired for, and this is the acquiree's estimated revenue. Now, the estimated revenue, it gives us a range. It's not going to be a single number, but we can see, for example, that this one had was a $320 million acquisition, and the revenue is estimated between 10 and 50 million. So that gives us a multiple of revenue range from 7x, which would be around a little less than 7x, which would be at the 50 million revenue range, up to a little 32x at the 10 million. So we have a range, and we can take some middle of the range numbers to get averages. And if we go through and look at enough transactions, we can get some pretty decent estimates there. And we can use that to build up our estimated revenue multiple at which companies in the sector are purchased in M&A transactions. In addition to that, we can go look at public markets. So if we go look at any publicly traded, let's say, for example, US publicly traded company online database, we can see what type of revenue multiples are companies currently trading at. Let's say if we go look at, let's say we go look, for example, at any publicly traded company database. So we can see, we go look at, we can go look at, for example, Amazon. We can see what's the market cap, and then we can see what's the revenue, and then we can go look at the financial statements. We can see what's the quarterly or annual revenue. So annual revenue 2023, 574 billion. Market cap around 2 trillion. So we can see exactly what multiple of revenue the company is priced at. So this is where we, so now we have some publicly traded multiples, we have some private market transaction multiples, and we can use the average to get the number here. So let's say in the end we come up with an average of 7 for medtech companies. So this means that we can now do our standard VC method not linked to DCF. Now, the first two cells that you see where it says cost of capital and exit and probability of success, don't worry too much about these numbers. I'll tell you what they mean. This is the VC's cost of capital, and this is the VC's probability of success exiting this startup at this exit valuation, which here is 738 million. So the key to these, how we're going to use these two numbers, we're going to try to adjust these two numbers until we get our required return in the target multiple box. Now, in this case, we learned about 30x in class, but let's say, okay, so let's say this company, we want 30x. So we adjust probability of success, 15. Now you notice my target multiple went to 24, so maybe we need a little lower. Yeah. So you can see at, I can just adjust. Yeah, now I got very close to 30. So, okay, 30x. Now we want to see what is the required funding, and now we got to put in what's required funding and post-money valuation. Now, remember, what we're trying to solve for here is post-money valuation, because post-money valuation is the valuation at which we're going to offer to invest in this company. And we can figure out, we can see right away that the maximum post-money valuation here is around $12 million in order for the model to tell us to invest. So let's say the company for example, the company is raising, let's say they're raising $500,000. We can now give them, say we give them post-money valuation of 11.9. And you can see our model still recommends that we invest. We would get 4.2% equity here, which is a little bit low. So I think we might want to get a little bit more than that. But that gives us invest. If we increase the valuation, let's say we increase the valuation to 15 million. Oops. Now we can see model says do not invest. So that means valuation is too high. And we can play around with these two numbers to get an invest recommendation. And remember that this will give us the maximum post-money valuation that we're willing to offer for the amount of money that the company's raising, the projected year 5 revenue forecast, and the exit multiple that we have derived. So that's how you use the model. Again, we go back to 11.9. And that means this deal is good for us. What we should remember here is, so this would apply. Company wants $500,000. They say that they have, or we have calculated that they're going to generate 105 million in revenue in year 5, and we want to generate 30x return. If the company is later stage, we could do with a lower target multiple. So we can, you can see that if we, let's say we decrease cost of capital. Now we're at about a 20x return, and you could see valuation now could go all the way up to around almost 18 million. And we would still get an invest recommendation because this would be appropriate for a later stage company where we don't need 30x, but we're willing to accept 20x. So anyway, that's a quick run through the financial model, what you need to do to complete the assignment. And hopefully this helps you to complete the financial analysis assignment. If you have additional questions, don't hesitate to message me in the line group, and I'll be happy to answer the questions there. Thank you.